All right, let's dive into the latest earnings from AZZ Incorporated. Now, on the surface, this looked like a pretty straightforward miss, and yeah, the stock took a hit. But when you look under the hood, there's this really fascinating story playing out. It's a tale of two completely different businesses pulling in opposite directions. So today, we're going to break down that story, look at what management's doing about it, and figure out what it all means for the company's future. So here's how we're going to tackle this. First, we'll hit the headline miss that got everyone talking. Then we'll get into that tale of two segments I mentioned. After that, we'll look at management's playbook, what they see on the road ahead, and we'll wrap it up with our take on what to watch for in the next earnings call. Okay, first up, the headline miss. To really get what happened this quarter, it helps to start with the market's reaction. It tells you exactly what investors were zeroed in on. And the reaction was swift and clear. The stock dropped almost 5% right after the announcement. That's a pretty strong signal from the street. So what were the numbers that trigger this? Well, here's the reason for that drop. AZZ missed analyst expectations on both the top and bottom lines. Adjusted earnings per share came in at $1.55, just a few cents shy of the consensus. But the bigger miss was really on revenue, $417 million, which was almost $9 million short of what analysts were looking for. A double miss like that, that's always a tough pill for the market to swallow. But here's the thing. Those headline numbers, they kind of hide the real story here. The key to understanding this quarter isn't just that they missed, but why they missed. And the answer is this incredible split in performance between the company's two main business segments. And here is that split, clear as day. On one side, you have the metal coatings business, which was just on fire, with sales up almost 11% year over year. But on the other side, you've got the Precoat Metals segment, which stumbled pretty hard, with sales dropping over 4%. This is the central conflict of the quarter. It's like one engine is redlining while the other one is sputtering out. So let's talk about that growth engine first. Metal coatings is absolutely crushing it, and it's all being fueled by this massive wave of public and private infrastructure spending. We're talking big projects in solar and electrical utilities, where demand for galvanized steel is just through the roof. This huge macro trend translated directly into higher volumes and that really strong double-digit sales growth. Now, for the other side of the story. The Precoat Metals business is really feeling the pressure from a slowdown in some of the more cyclical markets. We're seeing softer demand in building construction, and that has a ripple effect on things like HVAC systems and appliances. And on top of all that, management also mentioned that some uncertainty around tariffs is causing customers to hit pause on projects that aren't tied to that big infrastructure boom. And hey, you don't just have to take my word for it. Here's exactly how CEO Tom Ferguson put it on the call. He directly contrasted the strength in metal coatings, which he said was driven by infrastructure, with the pressures facing Precoat. This quote just perfectly sums up that whole tale of two segments narrative. So, with one part of the business booming and the other part struggling, what is management's game plan? Let's take a look at their playbook and see how they're actually managing their money and operations in this kind of mixed environment. They were definitely busy this quarter. They made several really smart moves. First, they refinanced a big loan to cut their interest payments, which is always a good idea. They also doubled down on their stronger segment, buying a new galvanizing facility for about $30 million. And they did all of this while still paying out a dividend and keeping their debt levels really healthy, at just 1.7 times their annual earnings. It all points to some very disciplined financial management. And the reason they can pull all this off, it really comes down to cash. Despite the mixed results on the top line, the business still churned out over $58 million in cash from operations. That's up 23% from last year. This is the fuel that allows them to invest in growth and keep shareholders happy. It's a really key sign of the underlying health of the business. Okay, so that brings us to the future. Now, given the revenue miss and the clear softness in Precoat Metals, you might think management would dial back their forecast for the full year. But they didn't. Let's dig into why. This is the big question, right? You miss on revenue and earnings, you've got clear weakness in a major part of your business, and yet you're holding the line on your annual forecast. To me, that signals a pretty deep level of confidence that they can navigate what's coming in the second half of the year. Management came out and reaffirmed their full-year guidance across the board. Sales, EBITDA, earnings per share, the whole shebang. Now, they did hint that the final numbers might land in the lower half of that range, but the key takeaway here is this. They didn't blink, they didn't lower their expectations. So, why are they so confident? Well, they're basically betting on a few key catalysts to kick in during the second half. First, they expect that fire hose of cash from the Infrastructure Act to keep the metal coating segment humming. They also described their M&A pipeline as robust, so don't be surprised if another acquisition is on the horizon. And even in the weaker Precoat segment, they think there's a chance to grab some market share from foreign competitors. And finally, their brand new facility in Missouri is just starting to ramp up, which should give them more capacity. All right, let's pull this all together. We've seen the miss, we've unpacked the two-segment story, we've looked at management strategy, and we've heard their outlook. So what's our final take on AZZ heading into the next quarter? Our take is market perform. It's pretty straightforward, really. You've got this powerful growth engine in metal coatings, fueled by infrastructure spending, but it's being almost perfectly canceled out by the cyclical weakness in Precoat Metals. Because of this balance, we expect the stock to pretty much trade sideways until one of these two stories changes. The big question for investors is which one will change first. So looking ahead to the next earnings call, here's what's on our checklist. Number 1, we need to see any sign of stabilization in Precoat's markets. Is the bleeding stopping? Number 2, execution. Did they actually close a deal from that robust M&A pipeline? Number 3, margins. How are they holding up in both segments? And finally, we'll be listening really closely to their commentary on those infrastructure tailwinds. The answers here will tell us if this balanced story is about to finally tip one way or the other. And as always, just a quick reminder that this is for informational purposes only. This is not financial advice.